Hello, my name is Garrett Nall from Texas A&M Commerce, and today I'm presenting on the current expected credit loss modeling and its effect on community banking. Today's overview covers the ACCL, or the allowance for loan and lease losses, the current model called incurred loss accounting, the new model that's to be implemented called the current expected loss, or the CECL model, and the CECL model difficulties for community banks, and finally, alternative recommendations for community banks. The allowance for loan and lease losses. This is commonly called the ACCL in banking. This is a contra asset account on the balance sheet that is used to reserve for loans losses on their financial statements. Currently, the Federal Reserve states that the ACCL is used to estimate total credit losses on a portfolio of loans given the facts and circumstances since the evaluation date. It's super important that banks properly reserve for their loan and lease losses so that they have available funds when they do have to eventually write off bad loans. The ACCL is currently calculated on the incurred loss model. This model has been used for quite some time now, but critics of this method point out that the reserve balance fell short of needs in the most recent financial crisis back in 2008. When this happened, they realized that it was time to look for a new or a different model. In response to the shortfalls under the incurred loss accounting, the CECL model was developed. This increases a bank's loan loss reserves due to life of loan loss projections. Incurred loss accounting. Before we get to the CECL model, let's go over what incurred loss accounting actually is. This method has been used since 1975 when the FASB published their journal article, Accounting for Contingencies. Under the incurred loss method, loan losses and associated reserves are not counted for until a probable loss event has occurred. Probable loss is a broad topic that is intentionally left broad so that banks can make their choices on how they properly implement that. Some banks may use a rating system from 1 to 10, with ratings 6 through 10 typically being associated with some sort of reserve, or some banks may just simply use the term non-accrual or non-interest bearing as their method for seeing a probable loss event. This method, the incurred loss accounting method, requires the following steps to identify and reserve for loan losses. First, the loan review department has to review the portfolio on a regular basis. Secondly, they have to go through and identify probable loss events. This is either the rating system or the non-accrual system. At this point, they have to reserve and report loan losses on the bank's financial statements. Each bank has a different way of reserving for these loan losses, and it's very difficult to find the information needed since it's usually proprietary to actually give accurate figures on how and what they reserve. Finally, after they've reserved and reported these loan losses on their own internal financial statements, they have to write off these accounts when they deem them uncollectible. Some of the difficulties under incurred loss accounting include it's reactive to the environment instead of proactive. We can see this back in 2008 when many loans went bad really quickly. Instead of having loan loss reserves that were already there on the balance sheet, the banks had to go through and immediately increase their reserves, and oftentimes they didn't have the capital to reserve enough for it. Secondly, these reserve accounts tend to be too low when the financial crisis hits. So when they're too low and they try to react to the situation, they realize there's not enough capital left for them. Under the new model, the current expected credit loss model, the CECL model, this started to take shape in 2009, right after the end of the financial crisis. The FASB settled on this new model in 2012, and currently, banks have until 2020 or 2021 to implement this model. Banks that are SEC filing and large banks, they have until 2020, and community banks and other smaller banks that are privately held or do not report to the SEC have until 2021. The CECL model is quite complex, therefore I think it's important to use the definition of the Office of the Comptroller of Currency so that we can understand what it really is. The allowance for credit losses is an estimate of the expected credit losses on financial assets measured at amortized cost, which is measured using relevant information about past events, including historical credit loss experience on financial assets with similar risk characteristics, current conditions, and reasonable and supportable forecasts that affect the collectability of the remaining cash flows over the contractual term of the financial assets. In concept, an allowance will be created upon the origination or acquisition of a financial asset measured at amortized costs. The allowance will then be updated at subsequent reporting dates. This new model forces banks to recognize and accrue for losses well before a loss event has actually occurred. This is important because now, instead of being reactive to probable loss events under the previous model, now banks have to start reserving at the very beginning or the initiation of that first loan. Continuing on with the CECL model. The CECL model has several benefits. First, it has greater transparency. Banks can report their financial statements and show loan loss reserves up front for their entire loan portfolio. Secondly, there's much higher reserves in these loan loss reserve accounts. In fact, one of the sources in my research paper points out that these loan loss reserve accounts will initially double upon the implementation of this new accounting method. And the third benefit of the CECL model is the reduction in the volatility of earnings. When the banks don't have a constant reactive environment when dealing with these loans, they will be able to show smoother earnings and fewer losses in the future. Some of the necessary requirements for CECL include increased data requirements, significant expertise in financial modeling and forecasting, as well as increased staffing and technological needs. The things that are needed for the CECL model tend to have some difficulties that are associated with them. Oftentimes, community banks don't have the necessary staff and operations expertise to handle this. But first, before we go on, we need to define what a community bank actually is. Community banks are defined in its most basic form by the FDIC as banks that operate in a relatively small geographic area with maximum assets between 1 and 10 billion. There's a lot of controversy on whether 1 billion or 10 billion is what should be used for the community banks. Therefore, in order to remain conservative, we will use $1 billion as the maximum cap for a community bank. You can call these, I guess, smaller community banks. These smaller community banks that are under 1 billion may have difficulty with implementation of CECL due to the following: proper loan data analysis, which may require outside software for data mining. Oftentimes, when you go into a smaller community bank, they've been using Excel spreadsheets, they've been using older software, and they don't have proper standards for what they use for entering in the data that's required on these loans. The CECL model requires a significant amount of data to properly analyze a portfolio and reserve for those loan losses, and without that proper data, it may be difficult to do it correctly. Secondly, the CECL model requires increased staffing needs due to the complexity of CECL forecasting. Oftentimes, a loan review department at a community bank is between 1 and 4 people. If you have the new CECL model, it may require 1 to 2 people in addition to the loan review department just to handle the data mining and the forecasting that's necessary, since there's loan losses and reserves calculated for every single loan that the bank initiates. Third, the increased reserve accounts, which may decrease the overall lending and potentially eliminate certain specific areas of lending. When banks have to increase their reserve accounts, that means they have less capital to actually be able to lend out. Banks make their money through lending and interest income primarily, and this may be difficult for some of the smaller banks that depend on that for their bottom line. This leads me to my alternative recommendation. It's a simple recommendation. It's my opinion that the most effective alternative would be to allow community banks under 1 billion the option to continue using the incurred loss accounting method. They have the option to use the new CECL model if they are so inclined, but they are not required to do so. The benefits of this alternative include no new costs on the bank side. They have already been doing this for years. They won't have to implement any new software changes, any new staff, or any new operational efficiencies. Secondly, regulation by bank examiners is already well regulated and structured. Bank examiners have been doing this for years as well. They can come in, regulate, examine, and look at these banks and do the same thing they've done for years, instead of having to rely on a brand new model that's both difficult for the examiners and for the banks to implement as well. Third, it prevents smaller community banks from improperly implementing this policy while monitoring the effectiveness of CECL through big banks that have